Hi, good afternoon, everybody. Thank you all for joining in on a Saturday afternoon. So today's topic is, the world is betting on India. What is it that you, as an investor, should do? So today on this webinar, me and Roshan are going to present. If Roshan, if you can just move on to the next slide. Right. So let's look at what do NRIs really want. Uh, they want their investments to be goal based. They don't want any operational inefficiencies to come, that might hamper, you know, for them to meet that goal, whether they need to get that money. How do they really go out and achieve that goal? It should be easy for them to go out and start doing it. Things should be very transparent. They should have a view of all their asset classes, where their money is going is something that they want to know. It should be very transparent in nature, and whatever transaction they do, it has to be done very efficiently. There should be no problem in putting money from where they are to putting money in India. That's what NRIs really want, right? Roshan, if you can go to the next slide. Right. So when you look at what NRIs really want, and you look at what's lined up for the next year, I think we can come up with a good union here. So what are the themes of 2024 that we're looking at that investors residing outside of India can really look at for India? First one is consumption. So today, going back 20 years, the bottom of the pyramid, that is the low class, uh, uh, was very high, and now we are moving towards a part where the lower class are actually moving up to middle, and middle are going up to upper middle. And that is a very good, it has taken a good 20 years for that entire trend to take place. And with digital India coming in, with a lot of ease of access also in terms of new products and in terms of product innovation, consumption as a theme is definitely a big thing to look at in 2024, right? The next two go hand in hand: manufacturing and infrastructure. There's a lot of there are a lot of MNC companies now looking at India very seriously to put up their plant, and usually when they come up, when they come in via FDI, it's very sticky. It's not, it doesn't go out very often, right? It's very, very sticky, right? So manufacturing and infrastructure do play a big role in the country's growth, and the country has really opened up in terms of how much they want to spend on infrastructure. And what they've been spending in the last 1 year is something that they not spent in the last 10 years, right? 10 lakh crore is a huge sum of money that they're willing to commit. And we've seen a lot of global companies do come here and become the partner up with India, with the government, with Indian companies also, to set up manufacturing bases here. See, what started in 2014 as a Make in India project is now heading into Make for the World project. Right? Make in India was very, very successful, and now that set up the base for us here, for product innovation, for efficiency in terms of manufacturing. And now it is going into Make for the World after the issues that have come up in terms of supply chain, where everybody is only going towards China. So the China plus one, the Europe plus one story is very strong, and it is developing as in the couple of years you would see a good amount of development coming in, right? The next thing is financial services. India as a country is very underpenetrated in terms of financial services. By financial services, I mean insurance and other related businesses. India is very, very underpenetrated, right? And our banks, compared to other banks globally, also we are quite big, right? But in terms of valuation, right now, things are looking very, very strong. Our credit growth has been extremely strong, and our deposit base is now looking forward to build up, right? So for us to fund such infrastructure growth, for us to fund such manufacturing growth, your banks need to be in a very good shape. And right now, in the last 5 years, we've had a good cycle of deleveraging, where our banks have gone out, they've gotten recapitalized, all the NPAs have come down, and today they're in a very good shape as an entire pack, right? When it comes to private bank and public bank, to be in a very good shape for them to go out and start funding for private projects, to start funding for public projects, right? So that's where a majority of opportunity lies here in India. First is has got to do with a lot of financial services. Now when it comes to global technology, we are seeing a wave of this is not just in terms of AI, but in terms of who is leading AI. Where is the supply coming from and where is the demand coming from? Right? We are moving into that direction where things are looking very interesting when it comes to uh, capacity that they're putting up in terms of AI growth and in terms of ML growth. But needless to say, that is very nascent. Yes, it can prove to be a very big theme in 2024, but it's still developing. It still has a long runway to go. Country specific, yes, there are opportunities opening up on the technology side, be it in Asia or in North America. Right? If you can go to the next slide. Right. So let's look at what has been happening in India. And in 2023, in terms of foreign investors, a lot of money has gone out. The entire market has been supported by domestic investors here in India. That you can see even in our SIP numbers. Your SIP contributions in India have hit an all-time high of 17,000 crores, uh, which is very good. There's a lot of financial inclusivity happening now, where investors are taking the financial market very, very seriously. They say, yes, this is a part for us to go out and start building well. This is a vehicle for us to start using it as a savings vehicle, right? But FIs have had another story this in 2023. They've pulled out a lot of money. Yes, they have come back in the last 1 or 2 months, but in the entire year, yes, they have been pulling out money, and the entire market has been supported by domestic investors, and domestic investors are basically you and me. So uh, what we are looking at in 2024, there are a lot of talks on how FIIs are going to come back in terms of flows alone, but domestic flows continue to remain extremely strong. And today, in today's valuations, the market do seem to be fairly priced in. It's somewhere on the expensive side, say 10% or so. But earnings growth for India has remained extremely strong. Right? So that's the broader picture of what the flows are actually telling us. Right. So if you see the flows also in terms of what's been happening to Nifty, this was previously where the entire story was, yes, only when FI money comes in that Indian markets do go up, but that's not the case in this cycle at all. Since COVID, what has happened is that domestic investors have been supporting this entire market, and the entire rally that has come in the last 1 or 2 years has been supported by domestic flows, and that continues to happen. Right? Even on a day-to-day basis, domestic investors are putting in a lot of money, and there's a lot of confidence in India among Indian investors for what the government is doing in terms of both policy and in terms of actual on-the-ground reality. So there's a lot of buoyancy, there's a lot of bullishness coming in on the Indian market side across the world. Right. So now I would invite Roshan to come take over. And Roshan, you can come take over now.
Yes, thank you. Um, so the India opportunity, right? So what is the India opportunity? So, and how has it changed over the last 5 years? So firstly, we have GST and the insolvency and bankruptcy code, right? So these two have transformed India into a more compliant economy, right? So your tax revenues are buoyant, and the IBC has also brought in solutions to long-standing disputes or issues, right? And the entire process of how a company is declared insolvent, and how that is and how you bring a resolution to that, right? It's come a long way since we first started implementing the IBC and the NCLT process, right? And now and today, this entire process is structured and with clear guidelines. And the financial system today is much healthier and much more clean than it was before, right? Before, as in even like the last 5 years. And our banks are now, very, very extremely well capitalized. Your NPAs are at multi-year lows, right? And the entire system has gotten much leaner. And your adoption of technology by the financial system is still on the rise. It's been it's night and day difference from even 3 years ago, right? Even just pre-COVID to now, it's a night and day difference, and it's still growing, right? And you also have the PLI scheme, the production linked incentive. So this scheme has opened up way more job opportunities for the manufacturing sector, and your electronics manufacturing has been one of the most successful parts of the PLI scheme, and we've already attracted over 5,000 crores of investments, and the value contribution of the 5,000 crores is around 2 lakh crores, right? So that's an incredible ROI number that you're seeing there. And out of that 2 lakh crores, 80,000 crores were exported outside of India. So 80,000 crores worth of product was for the export market, right? And talking about the export sector, right? The export sector is also expected to see incredible growth going forward. So we've already seen companies like Apple, Google, right, manufacturing India and exporting from India over the last 2 years. So if we see pre-COVID, India's export sector was growing at around 5-10%, right? But over the last 2 years, we've seen an annual growth rate of over 15%, and this is only expected to go up. So your supply chain diversification worldwide, right? The PLI scheme, greater capex into manufacturing, M&A activity, all of these are making India into a global heavyweight when it comes to manufacturing. So right now, what do we need? We need a clear export strategy. We need correct execution and capex efficiency, right? So if these three click at the right place at the right time, we can see Indian companies, get propelled into global recognition very soon, like much sooner than we expect. So let's see some investment favorites for the NRI, or rather, they were the investment favorites for the NRI, right? So firstly, NRI FDs. So when it comes to NRI FDs, your investment horizon is set by the banks. So it's kind of inflexible if you're investing with a goal. But that being said, if it does match, if the FD's time horizon does match with your goal, then this is a pretty good option, because it's tax free, and if you invest in at a time where the interest rate is fairly attractive, it is still a good option. And when we look at this year's budget, right, the tax benefits for your endowment policies and money back policies have been reversed if your premium exceeds 5 lakhs. So similarly for ULIPs, the maturity proceeds are also taxed. So in the long term, these options neither provide sufficient returns nor do they provide adequate cover. And the returns that these products of these products would be similar to your bank FD, or in some cases below that as well, because your ULIPs have the added cost of management and of the insurance policy as well. They would eat into the underlying fund, and the returns of the fund may be good enough, but when you add all these hidden costs, right, your cost of the product goes up dramatically, right? So instead of a ULIP, you might as well look into buying a term plan for insurance cover and a good mutual fund for market exposure, right? So this option would end up cheaper for you and would give you better returns in the long run. So moving on to real estate, right? Finding and monitoring the property is the first major hurdle. And there's also the question of tenant behavior with regards to maintaining the property and paying rent. And eventually you might need to conduct repairs and this needs to be made even if the house is kept idle for too long, right? So an asset that's supposed to actually create income for you might as well end up costing you more just to maintain it in the long run, right? So when it comes to structured products, they're debenture-esque products similar to an NCD, right, or a bond, which are linked to an index. In most cases, the Nifty. So if the structure sounds familiar to you, MLDs are a type of structured product, right? So they come with a predefined condition on returns linked to the performance of the underlying index, both on the downside and on the upside. And another thing you need to keep in mind is the risk profile, right? So most investors will not have the adequate risk profile to comfortably invest in these products. And when I say comfortably, I mean like not financially, but in terms of like mental peace, right? Um, so they are in essence a derivative product, right? And they can sometimes be extremely complex with various stipulations for payoffs. And they're generally very fee heavy in most cases, right? And the payoff is not worth the risk that you're taking. And by actually investing in the underlying index, in some cases, you would end up making more returns or in some cases, less losses. Now let's look at a few ways to address some common investment mistakes, right? Your priority must always be to beat inflation. So chasing higher returns almost always leads to recency bias. As a chaser, you're on the back foot, right? So if you make smart investment decisions, the returns will come in due time. Investment returns are in most cases linked. Investment returns are in most cases linked to the macroeconomic factors, right? So your return expectations must be linked to macroeconomics as well. So you make investment decisions based on future macroeconomic outlook or industry outlook if you're doing like a sectoral investment, right? And not on the past performance of a stock or an index. So when investing in a product, you pay attention to the cost versus what the product does and the work that goes into it, right? A cheap fund does not necessarily mean it carries the best value or it offers you the best value, nor an expensive one means that it offers the best performance, right? So you should look at the cost more holistically and not just based on how the fund has performed in the past. So over most of the last decade, right, we've seen leverage working really well. And this is because your cost of borrowing was cheap. Now, borrowing costs have increased across the globe, and we still see a lot of investors, borrowing and investing. And we feel that this will not work as well as it did in the last decade, simply because your costs are higher, right? So if your costs are higher and you do the same thing, eventually the higher cost will eat into your profits, right? So a complex product does not necessarily mean a better product or a product that would deliver outsized returns. So we saw that in the last slide regarding structured products, right? A lot of complex products may hide a structural disadvantage behind that complexity. So when you see a product that's really has a lot of things going into it, a fair amount of skepticism is warranted. So coming to tax, it's a thing that all investors do consider. But this harms the portfolio when taxation actually drives investment behavior. So when a certain asset class might be very attractive and is expected to outperform all the other asset classes, investors may neglect that asset class just because it carries the aspect of higher taxation, right? And this approach would hinder your portfolio's performance for that period, or may hinder your portfolio's performance in the long run as well, depending on how that asset performs. Lastly, coming on to the currency factor. So currency movements are inherently very difficult to predict accurately, even for experts, right? Because there are too many factors involved. So you can optimize currency risk by minimizing the layers in your portfolio. And you can also try to be more direct when making foreign investments, right? So what do I mean by that? For example, if you're investing in a fund of fund, right? Um, some of these products may route investments through multiple countries and multiple currencies, right? So this adds layers of currency risk in your investment portfolio. So instead of going through 2 or 3 different intermediaries in your investment, you may want to consider directly investing in a fund based on the country that you're investing in. Right. So which asset class do you think is the best for wealth creation? So we have 4. We have emerging market equity, we have global equity, we have fixed income and rates, and we have gold and other commodities. So I request you all to put your answers on in the chat box, and we can see the results on the next slide. We have 1 for emerging market equity. We have 2 for emerging market equity and 1 for global. Right, so wait for like 20 seconds and we'll move on. Right, so the answer to this question, as with most things in life, is it depends, right? So the first thing you need to understand is assets work in cycles. So what worked yesterday may not necessarily work tomorrow. And looking at this chart, we can clearly see this hold true, right? So if I want to take an example, if we look at 2014 and 2015, and we look at commodities, right? It was the biggest loser, but it was also the biggest winner in 2016, right? And if you look at emerging market equity, as some of you said, it also went through a similar period between 2008 and 2011, right? Your biggest loser in 2008, your biggest winner in 2009, your second biggest winner next to gold in 2010, and again your biggest loser in 2011. So the real answer is that it actually depends. Now, this holds true for countries as well. So if you take the US out of the equation here, and I'll let you know later why we're doing that, you can see a sort of rotation and returns between Asia, Europe, and China, right? So with So with the current macroeconomic and geopolitical climate, we can expect this table to look very different for the next 10 years, right? So what we must um, remember in this sort of decade of performance is that the performance for the US came in at a period when borrowing costs were near zero, right? So when your cost of borrowing and your inflation are higher, the same level of performance is very, very difficult and almost unlikely to be matched, right? Um, so, and again, when we look at the geopolitical climate for the next 10 years, the India opportunity as well looks very, very different, drastically different the from at least the first 9 years of this period or the first 8 years of this period, right? So that again will play a factor when we revisit the slide 3, 4, 5, 10 years from now. Right. So now I'd like to hand over the presentation back to Harshil. You can take over.
Thanks, Roshan. So let's talk a little bit about Neo. So Neo was not started a year back or so. We are going to complete 2 years in uh, October, but it was not started in 2 years. We've been running this sort of a model for the last 12 years. We used to run it as an advisory service for our clients, and it has taken us 12 years to develop this sort of model, develop this sort of a product. So we have real-time performance validation. All of our performance is validated. It's all real time. It's all client level. The only issue that we had with the advisory service was operational and transaction issues, and that making it into a product does become a lot more easier. So it is very easy for us to transact, and for you also to transact into the product. We made it very easy. We made it very transparent. That it's easy for us to go from one asset class to another asset class very, very simply, very easily. This way, we are able to take advantage of whatever opportunities do come up in the debt side, in the equity side, even on the precious metal side. So we don't have a cap on any particular asset class. Uh, we are completely dynamic in terms of our allocation. We are multi-asset by label, but we can go 0 to 100 in equity. We can go 0 to 100 in debt, and within equity also we can go 0 to 100 in direct stocks, or we can use ETFs. We are also taking advantage of uh, global ETFs that are there in India. We are also prepared for whatever changes come up in terms of exchange, that we are able to buy a direct global stock on our exchange. So whatever changes do come up, we are very well prepared for it. And this is a product that is curated exclusively for NRIs. So uh, uh, whatever requirement you have, as an NRI, we will be able to cater to you with whatever operational needs that come up. Neo is that product that can help you build your wealth here in India. How is it that every investor can really go out and win? When you're betting on India, bet big is what I would say. This entire decade, India is the only country that is giving you 6.5, 7% or GDP growth. And if you're looking at betting on India, bet big. So we think that every investor needs to be at the right asset class at the right time, at the right place, and this is what Neo does. We are able to take advantage of every asset class that comes up, and we don't, like I said, we are dynamic. It's not necessary for us to have 100% or even on 5% odd in an asset class if it doesn't make sense for us to do. Right? The next two things go hand in hand: engage with opportunities and consistent contribution. Now, we understand that when NRIs look at mutual funds, they only look at it from a point that yes, we can scale up money here. And Neo is also a very similar product to that of a mutual fund, where we accept SIPs, where you can consistently contribute. Because here we are not going to run out of ideas. You are not buying into a model portfolio here, right? Depending on the opportunity, let's say if an investor comes up now that investor's portfolio will look completely different than that who came in 6 months back, because 6 months back the opportunities were different. 6 months later the opportunities are different, right? So this gives us the appetite to take on more and be at the right place, be at the right asset, engage with the right opportunity. This way, when you can engage with the right opportunity, where you can consistently contribute to that particular idea, to that particular portfolio. Right? So every portfolio is different. Not it's not going to be the same for every investor that comes in. Right? The most important thing is, yes, you can align your investments with Neo to a particular target, to a particular goal. All of those investments can be funded to a particular goal. Even within the portfolio, if you want, we can separate out investments that can go towards a particular goal. So this is how we think that every investor can sort of go out and win. Right. So what is our priority? The way we look at Neo, the way we look at long-term building in India, is our number one priority is to beat inflation. Right. Today, inflation in the world is very, very sticky. Fortunately for India, we have seen high inflation over multiple years. Right now, our inflation is very well controlled, and we think that beating inflation is the only target that we should have. Not the equity market. Beating inflation and beating your fixed return is what we aim to beat over a very long period of time. Uh, when we pay attention to cost, we are very conscious when it comes to what we want to pay for a particular business. We are value conscious, but at the same time, we understand that because our investing is aligned to buying businesses with low debt, buying businesses that is hard to replicate, we are paying a little bit of a premium, but we are very value conscious in terms of what we want to pay to a particular business. Leverage works when it's cheap. However, it's not the solution to anything. Leverage is not the solution to anything. We don't take any leverage in our portfolio, and we will not take any leverage in our portfolio when it comes to building wealth in India. Right? Everybody has this notion that, because, and Roshan covers structured products, but complexity is not equal to performance. Investors do think that complexity means more performance. We at Neo have kept things extremely simple. If it makes sense for us to buy a particular business at that particular valuation, we go out and start building our position in that particular business. So we don't look at things from a very stock price perspective. We only look at it from a business perspective. That's why it takes us about a year or so just to build a very, very good position in that particular business. So we don't have a particular cap also when it comes to buying into a particular business. Okay. So let's say, for example, we are buying 5% or in a particular business in the portfolio. That doesn't mean we stop at 5. We don't have a particular cap also. We can go overweight and we can take concentration risk when things go in our favor. So complexity is not the only means of how you can make performance. We keep things very, very simple at New. Right. So in terms of performance, since inception, so our inception is October of last year, and in 2022, since inception, our returns have been somewhere around 29.5%. Though this is a very short-term period to look at, our endeavor, like I said, is for us to beat inflation. Our priority is to beat inflation and fixed returns, and anywhere between our endeavor, our expectation that we want to set for 10 years plus, because we don't want to work with investors who have a horizon of 3 years or so. We want to work with investors who have a horizon of more than 5 and 7 years. There, the endeavor is that, yes, this multi-asset sort of an approach does grow somewhere between 12 and 15%. And that's what our endeavor is, to grow at these numbers for a very long period of time. Now, in terms of our asset allocation right now, if you look at our asset allocation, 75% of our assets are in equity, but a major chunk, that is the next major chunk, 12 odd percent, is in precious metal. Right, so we are able to take advantage of precious metals here. And in terms of global ETFs, we have some global exposure towards Asian countries. So that happens to be somewhere around 4%. And everything else is a mix of liquid ETF and equity ETF. Wherever we are able to take that advantage, we are taking that advantage. So even on the ETF side, we have a basket approach. So for example, you would not find us invest in any broad-based sector or broad-based idea. What we do here is layering our idea. So for example, if we are bullish on infrastructure, we would layer it either with an ETF or via direct stocks. So here we've been able to take direct stocks. However, when we look at financial services as a theme, we were able to take advantage of public sector as an entire pact when it comes to building a position on the banking side, supported by other financial service companies like insurance, general insurance platforms, that we were able to do via direct stock. So everything is a basket, and we layer it, and the layer keeps changing. Sometimes you would have more ETFs, sometimes you would have more direct stock. So whatever makes sense for us to do, we would do. Right. So I think now we can open the floor for Q&A. We've put in our number and our email ID. So if you are interested in Neo, definitely do get in touch with us. We would be very happy to assist you. We'd be very happy to build your wealth here in India. If you do have any questions, do put in your questions in the chat box. So there is a question on which Asian country has the highest position. See, right now, we are, so if you look at our fact sheet, whatever we put out publicly, we are looking at Asian technology. It's a mix of countries that come up on the Asian side. Concentration does come up from Chinese companies, but we have taken a wider exposure on Asian countries when it comes to technology that's coming up on the Asian country side. Gold performance on the next few years. See, I think there was also a chart, and I just did a webinar for gold, at 10 o'clock in the morning here, Indian time, where for the last 5 years, we've seen very, very high CAGRs that are coming on the gold side. And in terms of our allocation, also, we have a good exposure that is there on the gold side. So we are extremely positive on gold. Supply doesn't look to come up very fast on the gold side. It has remained stagnant since 2010, and the demand keeps going up. It's just that the cost to mine these golds have gone up, and gold as an asset class is highly undervalued. We do believe that it's completely undervalued, and gold needs to be compared to a particular currency. And just in terms of currency, the dollar looks to have peaked out given the economic condition of US. There's a lot of debt on the US side. The deficits also are very, very high. So just in terms of their macroeconomic outlook, gold does look like an asset class that is extremely undervalued. So we have been able to take a good chunk of exposure on the gold side. That is one of our precious metals uh, allocation. So we are very bullish on gold. We do think that gold can sustain this level of performance that has happened in the last 5 or 6 years. Thank you, sir. We still have a good 10 minutes or so before we close. So do put in your questions in the chat box. Uh, we'll do our best to go ahead and start answering them. Okay. So there is a question on Japan. See, when we were looking at global exposure, we did look at Japan also. And what we found on the Japan side is that because they've had very low inflation for decades altogether, now that they're getting that inflation, profit margins are increasing. Uh, but the hype that went around Japan was very, very high, and their valuation started to reflect some sort of a premium. So we did not look at Japan. But in terms of businesses that are there in Japan, there are very, very good businesses on Japan. Though we might not be able to look at it from a basket approach, there are very, very good businesses on Japan. Very good businesses. And so if we do get an option to buy them, say maybe directly, yes, we might evaluate later. But right now, a lot of money has flown into Japan. A lot of money has flown into Japan. From a foreign flow perspective, a lot of money has flown into Japan. And we want to evaluate it further. We're not negative, but we do want to wait and see what are the developments that can come. Which sector has good growth potential in India this year? So we had put out the themes that we're looking at for 2024, and our concentration is majorly going to be on finance and financial services. That is a sector that has a good runway for growth. Here we are able to go overweight on particular parts of the market that where we have conviction on, and we are able to build those positions gradually at our pace, buying it at good valuations. So these are the sectors that have very good potential for growth in India. Financial services, consumption, and infrastructure are three core sectors where you would find a lot of growth coming in the next couple of years. Thank you, sir. Happy New Year to you too. Thank you. Okay. So I don't think that there are any further questions. But if you do have any question on Neo and what Neo can do for you, and any other question, any other query, do get in touch with us. I put the number there, and also we put in our email address. So do get in touch with us, and we'll be very happy to assist you. Thank you so much for joining in, guys. Happy New Year. Have a good weekend ahead. Thank you so much. Thank you.